Hi, and welcome to Midas Investing. Today we're going to be taking a look at Heidrick and Struggles, ticker HSII. Heidrick and Struggles is an employment and consulting services company with a focus on executive talent search. I think this company presents an interesting opportunity, both in terms of value as well as the interesting tailwinds I think the company has in the industry going forward. Let's take a look at this one. Please like the video. It's the best way you can help us with the YouTube algorithm, and subscribe to the channel if you've not already. Also, consider joining our free Discord. The link is in the description below. All right, so hopping right into the third quarter presentation that they provide for us, just to get a general idea of what the company does. As I said, they do executive talent search, which makes up the bulk of the company's business, but they also have their more recently developed segment of on-demand talent, trying to provide on-demand executive talent with their well-developed pool of talent that they've managed throughout their connections throughout the globe. And then they've also had their more traditional forms of consulting under their Heidrick Consulting brand, leadership and culture shaping services that they have within that. Now, in this presentation, they also talk about their goal relative to their current state and their past state and their hopes for the future. What with the fact that they currently have 76% of their revenues coming from executive search, and in the past, that's represented about 95% of the revenues, with that last 5% being their more traditional forms of consulting. So they've expanded their traditional forms of consulting a little bit, more closer to like now 10% or something like that. And then they also have now, as I said, the on-demand talent that they've gotten another chunk as well. So their goal is to try to expand those other forms of their business into larger chunks of their business and make executive search a smaller chunk of their business. Now, I'll be fully honest. I don't really see necessarily a whole lot of success in this. They could be successful in that regard, but they don't necessarily give me a whole lot of reason to believe that this is going to be the state of their business going forward. So to be honest, I'm just looking at their executive search, and that's the thing that I'm actually interested in, and I'm projecting based off of that. And I'm really just assuming that the Heidrick Consulting and the on-demand talent is for the most part just going to stay in its current form. You'll see what I mean when we get into the model. Now, coming down to this other slide, they also provide a chart here showing the mix of the businesses that they consult for in the executive search portion of their business, showing that they're not just providing talent pool for executives in one specific sub market, so that if there's a hit in that market, that's going to have a big effect on their business. They're pretty well spread around the whole economy: 23% industrial, 27% financial services, technology, consumer markets, social impact, and healthcare and sciences. A pretty good overall mix. Gives us confidence that they're going to do about as well as the overall broad economy. They are definitely going to be cyclical in that overall sense. All right, so now I want to take a moment to show just one quick page within their 10K where they describe their client base. I think this is important because as we build up the model, you'll have to see kind of the assumptions that I make in the model and how that kind of applies here. But for the most part, most people think about executive search, they're kind of thinking about, lots of the companies that we like to value here on the channel, relatively large, publicly traded companies, Fortune 1000 companies and stuff like that. But overall, their actual market is a little bit broader than that. Major US and non-US companies, sure, middle market and emerging growth companies, private equity firms, governmental, higher education, and even non-for-profit organizations, as well as other leading public and private entities. I just want to kind of bring that out and comment on that because, if you're thinking in a more traditional C-suite format of the types of executives that would be part of that pool, the pool is both larger as well as within a single company, possibly narrower. And what I mean by that is like the average amount of people that are in the C-suite of, say, a publicly traded company might differ compared to the amount of executives that would be at a not-for-profit, for example. So we're going to have to make some assumptions in the model to kind of adjust for those assumptions. One other thing I wanted to comment on is that just here within the last week, they have actually announced a leadership plan. The current CEO and president, Krishnan Rajapalan, forgive me for getting that name wrong, has decided to retire after 23 years with the company. He's currently going to be replaced by the new CEO, who is currently the managing partner of their Norton Street Holdings sections of their business, and also was previously the CEO and president of DeVry University, Monahan. And then they also have a separate gentleman by the name of Tom Murray, who is currently the Heidrick and Struggles global managing partner of executive search, is going to become the president. So it's interesting that they're actually splitting up this role. I'm not going to have the president and CEO be the same person, but instead be the CEO, which is the executive that is hired by the board to operate the company, and the president, who is actually the operational manager. So they're essentially kind of splitting up this role a little bit. The current and departing CEO and president is also leaving the board, but he's planning to stay on as an advisor to help manage some of those customer relationships going forward in the future. So this doesn't really have a huge effect on my model or my overall valuation, since it's not really a story surrounding the executive, but I did want to at least comment on it since it is very fresh news. All right, so now we're going to take a moment to talk a little bit about the market opportunity. There's a reason why I'm particularly interested in this company, is because as I started to think about the executive search as a sub industry, I started to think about just how much it has going for it within the next decade. How many tailwinds there could exist for this industry going forward. How many of them will actually play out is a little bit of up in the air question, but it's something that I just want to think about. Now, one of the themes that we've liked to capture on this channel over the last year has been the idea of the aging boomers going into retirement, and the overall changes to the demographic structure of the United States, and how this affects the consumption as well as production in the overall economy. So one thing I wanted to take into account of this is that how that's going to affect the executives. As you can see right here, according to Korn Ferry, another major employment consulting firm, of the 1,000 largest U.S. companies by revenue, the Fortune 1000, the average CEO age is 59, whereas the C-suite on average is 56. Average tenure of said CEO at that current point was 6.9 years versus 4.9 for the C-suite in general. And then obviously it splits off into different executive roles as well, and then also splits it off by industry. And then also we have, those are the ages, then we also have the average tenure by industry. This is just one particular slide. The thing I'm trying to point out here is that what 59 actually represents. The people, the actual age of people that are basically about 59 or slightly older than that, and are currently going to be aging up into the mid 60s and the 70s, versus the people that are in the 50s and the mid 50s, and they're going to be aging up into this kind of age range where the CEOs are right now. That represents essentially the boomers leaving, and the overall Gen X generation starting to come in and fill those roles. And since Gen X is a much smaller generation, that's going to tighten the overall labor pool and create a much more strain when it comes to trying to find the right executive. Now, to back up this point, I found this other chart showing the average age of CEO at hires going back to 2005. Now, the chart only goes up to 2019, but you can see how the average age of CEO in the United States has been getting older and older and older over the last decade and a half. I think that kind of shows that the relatively large boomer generation, they were kind of essentially moving through those that pool of people, essentially going from boomer to another boomer to another boomer, and then not quite making it down to essentially to the next generation. And at some point or another, that essentially has to stop once all the boomers have actually retired. And in case you didn't fully believe what I was talking about in terms of the demographic structure, I wanted to pull that up. This here is the demographic pyramid for the United States, which essentially shows what percentage of people are at what age group at which points in time. I think this was, it's from 2022, so it's 2 years old. Right here, you can see this is essentially the baby boomers that currently remain with us. Obviously, it goes up to about 100 plus. So lots of people who are much older than that, the silent generation, have already passed. But the boomers are essentially right here in this wave. And then you can see that it gets a little bit thinner right here. This is the Gen X valley, so to speak, that I'm talking about. And then it moves back up into a larger wave, which is where the millennials are. Obviously, so you can see parallel on the same side on the other half of the chart. So on that first chart, I showed you that the average age of the CEO was 59, and then here we actually have the distribution of those ages. And I would show that it not only is the average age 59, and this chart seems to agree with it, though this is as of 2019, so this information is a few years old, but I would also point out that the tail is tilted to the right as well. So there's actually a larger percentage of the total outcomes tilted towards the larger amounts of the ages in the groups at all, which means that there's a larger amount of people that are going to retire sooner rather than later, according to this distribution as well. All right, so what does succession rates typically look like? I did find this chart showing both Russell 3000 and S&P 500 succession rates only going back to 2017. I wish I could have gotten this data for a much larger time series, but unfortunately that was about the best I got. But in general, it seems to me that for a typical company, you can kind of expect that like 10 to 12%. It does ebb and flow a little bit. And you can see 2020, there was a little bit of a dip, and then there was a big bump up after COVID, which is what the chart's definitely trying to highlight. But in general, we see about a 10 to 12% succession rate across history, which would make sense. You know, you would expect there to be a certain form of stability within that, because obviously people only live so long and companies are only so big with so much people within the structure. Now you might be saying, okay, well, now CEOs have successions, but is there necessarily mean that you're going to have to hire a company to do a talent search in order to find your new CEOs? Well, let's take a look at that. According to this distribution by bucketing of companies by revenue, you can see how many outside hires there were on a relative percentage basis. You can see around 50% of the overall placements were done through outside hire, all the way up through less than $10 billion in revenue companies. It does seem to peter into a smaller percentage for the much larger companies, which is very interesting to see. But overall, 10 billion and smaller, that's still a relatively large in terms of scale relative to the pool of companies that we're talking about for Heidrick. And then when talking about internally promoted CEOs, there's also the question of the tenure that they have in itself. You might want to promote internally for your CEOs because of the experience that they have. But we can see here that that tenure itself potentially has questions. Overall, we see that the tenure for the SP 500 was relatively stable here, and the Russell 3000 also relatively stable. But in general, there was a slight downward trend for the Russell 3000, and then there's this relatively large dip in 2022. So it seems that there was a relatively large amount of successions in 2022, but that was moving from relatively high tenure CEOs to relatively low tenure CEOs, which could create potentially an even faster pace of succession if those CEOs are going to get kicked out a few years down the road. Now, that's a little bit of a theoretic way of thinking about it, but the point is, I think it creates a potential speeding up of the booting out process, so to speak. And then likewise, this so the same company that did that other chart did this gauge of how many new inside CEOs were seasoned executives. I'm not 100% sure what it defines as seasoned executive. Maybe that means that they were already at an executive position prior to being promoted to CEO or something like that. That's my guess. But likewise, we see that same pattern where there was a little bit of a stable pattern to it, and then a relatively strong jerking downward in 2022, which I think potentially sets up a larger wave of turnover in the future. All right, now let's take a quick look at some charts of the data of the company before we take a look at our model. Here we have the distribution of the revenue going back for the last 10 years. And just as I had promised, you can see the executive search makes up the vast majority of their business. You can see that the more traditional Heidrick consulting has really made up just a relatively small portion of their business. It's not necessarily growing too much. In fact, in the last couple of years, it's gotten a little bit smaller, somewhat possibly at the cost of the on-demand talent, or possibly just the other portion of their business growing faster. And then on the on-demand talent, as I said, is the new segment of their business, which has grown into its size relatively quickly, though it's still relatively small in its total scale overall. Now, taking a look at the overall market opportunity here, as I had shown before, we can see the average Fortune 3000 CEO turnover, which has been about 10 to 12% for the last few years, going back to 2017. And then here, these bars is a number that I came up with, which will all kind of describe to you how I came up with that calculation in the model. But it's my estimate of the annual opportunity globally across my estimate of the total amount of organizations that are available to them, and how many potentially executives that would be needed for the talent search each year. So my estimate going backwards, and then it moves backwards accordingly based off of global population. And then within that, in their reports, they themselves report the total amount of search confirmations that they get each year. And so I took their search confirmations on the bars right here, and then the orange line is their percentage of the total share of that total pool that I had itself. So that's my representation essentially of their market share. So globally, as you can see right here, I show them as having essentially between 1 and 2%, climbing a little bit over the last 10 years. And then here we have a percentage chart showing their consultants, because they are a consultancy firm. So they do obviously hire a lot of consultants, and they report their consultants by their search segment as well as their Heidrick consultancy segment, none for the ODT. And then here I have those shown as percentages, partially because I wanted to show a little bit of the difference between their segments in the sense of their percentage of revenue. So here you can see, for example, that the search consultants make up 85% of their total consultant count, whereas for their revenues, we saw that it also made up about 84% of their revenues. Now, Heidrick Consulting made up about 7.5% of their revenues, while the Heidrick Consulting makes up actually about 15% of their consulting count. So what that shows me is that the Heidrick consultants are potentially a little bit of a more expensive segment overall. The Heidrick consulting in general, they have a more consulting counts, and so depending on how expensive those consultants are, that potentially is a much higher expense segment. And also, at the same time, you see that, for example, the search consultancy levels are still relatively consistent. It's just, for example, the lack of the ODT and a consultant count for that makes up the difference. And the reason why this matters is because this next slide that I'm going to show you is going to be their margins. So now, for example, here in the blue lines, we have the executive search margins, and we're looking primarily at something that's close to an EBITDA margin actually for this particular measure. You can see that in general, it's been high teens, possibly into the 20s in the most recent couple of years. And then we have Heidrick Consulting in the yellow line right here, which is negative every single year for the last decade. And then likewise for on-demand talent, also negative for the only 2 years that we have for it. And then the green line is the overall EBITDA margin. So you can see the combined of all the segments together. And it's worth noting that each of the individual segments doesn't include their global operations cost, which is essentially like cost that goes to all three segments. Whereas the green line does include that extra cost as well. So that includes all the costs of the company, no, except for, like I said, depreciation and then taxes and everything else after that point. So the reason why I show this is to essentially show you that for the last decade, their Heidrick Consulting segment has essentially been like a loss leader for the company. It's like they provide these other consulting services, culture shaping services, and advisory services like that, but they're not really making a profit on this portion of their business. It's the executive search portion of their business is where the profitability is, and if anything, the consulting portion of their business is really just something that helps them maintain their reputation as a consultancy firm, making sure that they're having meetings with all of the managements and getting to know all of the talent and stuff like that. And so it's something that I kind of wanted to bring up because, in their presentation, they were saying that they expect their other segments to become bigger portions of their pie. And then I was saying that I don't actually expect those segments to become a bigger portion of their pie. And I think that the history shows that they're not really likely to have that become a bigger portion of their pie, but it also shows that you wouldn't necessarily want that to happen unless they're going to change their cost structures either. So I'm personally expecting for the next 10 years it to look more like the last 10 years, because I think the last 10 years looked just fine anyway. So that is what it is. All right, so now coming in here to take a look at the model that I put up for the company, I'm going to try to breeze through a lot of this stuff relatively quickly because we spent a lot of time trying to go over the charts and the graphs that I found surrounding the industry, and I thought that stuff was a little bit more important. And as I kind of had already said, I make some broad assumptions when I'm trying to come up with my my annual opportunity for the executive search. And you can totally make totally different assumptions in a lot of different ways in some of these things, but I will say it doesn't really make a big difference because if my estimate of the annual opportunity for the executive search is too large or too small, that just has the reverse effect on the share number. So that just means if my opportunity is too big, the share number is too small. If the opportunity is too small, the share number is too big, right? It's just going to have that effect one way or the other. And so either way, it's a percentage. So the scale is going to affect it one way or the other. Long way of saying that I'm going to make some assumptions here. I know they're assumptions, they're probably wrong, but we have to make assumptions in order to make some sort of estimate for the business one way or the other. All right, so the assumptions that I made is I found an estimates online of total organizations by employee counts and annual sales in the United States, as well as organizations globally. And then what I did is I took the top 1% by employee size and by revenues, and that percentage of the businesses in the United States I applied to businesses globally, which is a relatively big assumption. And then I took that same 1%, and that gave me essentially almost 2 million in total organizations that could be applied globally. Again, keeping in mind this includes nonprofits, government organizations, relatively small organizations, relatively large businesses, pretty broad what organization could be counted here. Then at that point, I had to say, okay, well, how many executives on average is there in a C-suite? Which I did some searching around, and on average, it seems for publicly traded companies, the current number is around 7. But I assume that potentially it could be half that for relatively small companies, as well as nonprofit organizations. And so either way, I'm going to assume a kind of a difference between 5 and 7 for overall executive counts, and I 6 being the midpoint between that. And so I multiply this number times 6, and then I also, as I said, we assume about half of them are going to be internally hired. So I cut that number in half, and then I cut the number in half one more time, just to on the basis that I could be potentially way off, and I wanted to cut it down just for conservatism. Either way, that gets me to about 331,000 as an annual opportunity, which essentially means how many potential executives globally are trying to be turned over on an annual basis, which ends up being about 0.5% of populations, which I think is a relatively normal sense of scale of like management to employees for mid to large size companies. So that's my estimate for 2022. But then what am I doing for estimates going backwards? Well, this is where another big part of the assumptions come in. I'm just going to have the number go backwards in terms of the annual growth of the global population. So it's essentially just moving backwards at, like, 0.5%, 1% per year, which is the global population growth, which is a huge assumption. It would ebb and flow much more than that, but this is going to give me a broad number that I can assume over the long run. And that's what I have right here. And then, like I said, I took a ratio of the confirmations that HSII has as a percentage of that, which got me on average about 1.5% over the last 10 years. All right, so that's how I built up to the overall market opportunity. So now when I'm trying to put together the actual revenue assumptions for the company itself, what I do is I do make some assumptions about how many executives per organization there could be. In the bear case, we'll assume possibly 5, bull case about 7. I already kind of laid out my assumptions about how wide of an assumption that actually is. And then within that, we're going to, like I said, assume the annual opportunity that we saw within that. The search percentage, I am going to allow to vary by the deviation that we saw traditionally. So we're essentially just going to assume that they're going to maintain their average market share over the last decade, which gets me 1.5% to 1.8%. If I do that, that gets me to my executive search of about 780 million in the bear case scenario to possibly 1.4 billion in the bull case scenario. Now, they do give us those consulting counts, as I said before, both for the executive search segment as well as the Heidrick consulting segment. What I do is I do find out the dollar amount per confirmation that we get in the executive search, and then I take the dollar amount per confirmation and divide that by the total amount of consultants, which essentially gets me the dollar amount per search per consultant. So which is what I call the dollar per consult, which I have right here. And then what I'm going to use that for is scaling upward to my costs, so that we're going to say that, well, if you're going to have this much confirmations, you're going to need this many consultants, which is going to give you this much cost. And then the dollar per consult is going to scale upward with inflation. And then also the percentage for the other two segments, as I had said before, I don't really necessarily see a huge opportunity for them to really grow in the same way that that their presentation seems to imply. So what I'm actually going to do is I'm going to take a look at the average ratio of Heidrick consulting relative to executive search, which ended up being about 10.2%, deviating by 2.7% per year. And then likewise, I did similarly for executive search. Not executive search, for on-demand talent. And what I'm going to do is I'm just going to assume those ratios stay the same. So we're not really going to assume that that portion of their business grows. We're just going to assume it stays relatively the same in scale with the executive search. I do all that together, and that gets me up to total revenues of just under 900 million in the bear case and just under 1.8 billion in the bull case, a midpoint of 1.2 to 1.3 billion. Now, as I had already said, we're scaling up the executive search and the consulting costs based off of the amount of consultants they have, which I think makes perfect sense. Overall, as I had said before, we get a dollar per consult figure based off of the total confirmations and then the total amount of consultants divided into that. But then we can essentially figure out what is the cost per consult as well, and then the ratio between that, which on average, essentially the amount of money that they earned on each consult, about 84% of that goes to their consultants. So it's like, you can see the vast majority of the money goes straight out the door in that sense to them. And then likewise, as I had said with the other segment, Heidrick Consulting, it essentially is a loss leader. It, for the most part, is being subsidized by the executive search. It's really just something I think to help maintain their competitive advantage by making sure that they have their name out there as a consultant firm, or having conversations with the management on the regular, making sure they keep their ear to the ground in that sense. And we can see this, for example, what I'm calling the consulting subsidization ratio, which is essentially how much more are they paying for their Heidrick Consulting relative to their executive search, which on average is about 23% more. It's a ratio of 1.23 on average, deviating by about 30% in any direction given any particular year. And then likewise, as I had said, there is also the global operations support cost, which is essentially just more like their administrative costs, so to speak. And we scale those upwards with the rest of the costs as well. And that gets us to an EBITDA figure in our bear case of just about 15 million, in our bull case possibly 264 million, mid case of about 100 million. Now that gets us a relatively low EBITDA margin of 1.7%, possibly up to 14.7%, which is a really, really wide variance there. So I chose to normalize the bear case and the bull case by essentially just taking the average of that and the mid case one to get me 4.8 and 11, which is what essentially what I'm going to do is I'm just scaling it backward a little bit, pulling it in a little bit. Now, as I said, this is an EBITDA figure. If you look at their financials, their depreciation costs in general has been about 1.5% over the last decade, but it's moved from about 2% for the first 5 years down to about 1% in the last 5 years. It's kind of slowly scaling downward as their sales have scaled upward. And likewise, the reinvestments to match with that have ended up being relatively negative, meaning that they're actually depreciating much more overall relative to their capital expenditures. So what I'm going to do as a somewhat conservative estimate is I'm just going to assume in a bear case estimate about 1.25%, in a bull case 2.25%. The higher end getting on the bull case because depreciation being higher would make sense if they had higher capital expenditures, which they would have if their business had grown more. And so that's going to be somewhat of a conservative assumption, I think, in terms of getting us to an EBIT margin, which is what I like to use for my valuations, which gets us to approximately 4% for the bear case, 9% for the bull case, 6% for the base case. And actually in the valuation, I'm going to apply 8% for my bull case to be slightly more conservative, just a little bit more as well. I also did a pricing analysis for Heidrick. In fact, that's how I found them, was originally by doing a pricing analysis of small cap industrials. But then once I identified Heidrick and Struggles within that pricing analysis, I did one specifically of them versus other employment services companies, and which is the one that I have right here. And here is a summary dashboard of which I have EV to forward sales versus gross margins. And you can see that they're significantly underpriced versus the comp group on that one. You can see the best fits line being kind of a proxy for where the line of more or less underpriced would be. And then here we have EV to gross margins versus 2-year forward sales CAGR. And then they're, I believe, hidden right here, kind of underneath this particular one. It's a little bit hard to see them, but they're still significantly under the line. And then we have price to book versus return on equity, or not return on equity, return on invested capital, which you can see them much more clearly standing out as significantly underpriced. And then the summation graph, which puts all of the pricing factors together, they are one of the more underpriced versus their comp group, which was one of the reasons that put me on the path of looking at them in the first place. But I think that represents a separate also factor that is in their favor in terms of getting the valuation sooner. All right, so coming over here to the DCF template to take a look at what we put together with all the assumptions that we just talked about. So here you can see the revenue cases as I was talking about. Overall, as I said, in our base case, we're assuming a relatively modest amount of growth. We do see in our bull case some potential for them to grow pretty significantly, but for the most part, we're not really assuming that. This is mostly just a valuation play. We do think they have strong tailwinds at their back, but it's not really about them growing and becoming a much larger company. If they were to actually grow into some significant levels, I would actually expect it to come in a non-organic fashion, maybe them find some decent acquisition opportunities or something like that. And in our bear case, of course, we are assuming potentials for them to fall back in terms of revenue, but to be honest, we don't really think that's very likely with the tailwinds that we've discussed. And coming over here to the margins page, in the short run, we have the analyst expectations mostly in line as our guiding stone, and then moving towards the margin assumptions that I had talked about 6 about 4% in the worst case scenario, and then 6% in the mid case scenario, 8% in the best case scenario. And then between that, you can see the operating margin cases over time right here, operating incomes right here, and then the terminal year operating income distribution, kind of a split distribution, obviously with the kind of the wide margin assumptions, but anywhere between 25 million to possibly 100 million plus. This seems not really finding very many outcomes here in the middle. Now with capital assumptions, as I had said, with their historic financials, they actually had relatively large amounts of net negative reinvestment, and I'm for the most part assuming that they're going to have basically a balanced level between their depreciation and their overall investment level. So reinvestment of approximately zero for the most part going forward. So what that could mean is I could be actually relatively conservative on that front. Free cash flow distribution I have right here of between like 25 million and 75 million. It seems to be the majority of the outcomes right here, but that could end up being a somewhat conservative estimate if the past history in terms of the reinvestment were to repeat going forward. But I am choosing to be a little bit more conservative than that, just in case that's not the case. And then if we come over here to the distribution of the fair value outcomes, you can see that I end up finding the fair value to be about $42 to $43, with the interquartile range being between $35 and $50. So a pretty decent wide range of outcomes where to find 50% of the outcomes in. Expected returns between 12 and 16%. You can see the distribution of values right here and the distribution of the expected returns right here. But yeah, very, very solid returns expected, significantly below its 25th percentile is traditionally where we like to see companies that we might want to buy for our own portfolio. And well, spoiler alert, I have already added this to the portfolio. It is already more than 1% of our portfolio, and I am looking to continue buying, although it has already started to race upward. So it's possible that I'll have to stop at some point. But here you can see currently trading at the 11th percentile of the distribution that we've created, 41, almost 42% of returns to the upside, 14.1% expected returns over the next 10 years. Please like the video. It's the best way you can help us with the YouTube algorithm, and subscribe to the channel if you've not already. Also, consider joining our free Discord. The link is in the description below. So that's going to do it for Heidrick and Struggles, ticker HSII. As I was just saying, it's already in the portfolio, and I'm really happy to share this opportunity with you guys. As I had already said a couple times, it's not exactly one of the larger growth opportunities that I've been quite proud of over the last year, but I do think that even though it's just a value play, it's got very, very significant tailwinds at its back, and we're not really requiring any significant multiple revision in order to get these results. So we'll see how this one plays out for us. I'll catch you all in the next valuation. Bye.